Think your mortgage payment stays the same forever? Think again. Even with a fixed rate, your monthly payment can rise, and it can catch homeowners off guard if they're not prepared. You locked in your rate, you closed on your home, and you expect your payments to stay steady. But then, boom, your lender sends a letter saying your monthly payment just went up. Here's the thing, even with a fixed rate mortgage, your payment can and often will increase over time. And if you don't know why, it can throw off your entire budget. Before we dive in, don't forget to hit that subscribe button and ring the bell. Here on the Mortgage Cafe with Angelica, I serve you a fresh sip of wisdom on everything mortgages and real estate. I'm Angelica Obregon with Key Mortgages, your local loan officer serving Georgia and Florida. Let's talk about why mortgage payment rise over time and how you can stay one step ahead. What makes up your mortgage payment? When you make your monthly mortgage payment, it actually covers several things. Principal and interest. This part is fixed with a standard 30-year mortgage. Property taxes. These are paid to your local county or city, and they can increase as your property value increases. Homeowner's insurance. This protects your home, but premiums can rise every year. HOA fees. If you're part of a community association, those can also change over time. While your rate doesn't change, the total can't, because all of these other pieces are variable. The escrow factor. Most homeowners pay taxes and insurance through what's called escrow. That means your lender collects those costs in small monthly amounts and then pays them for you when they're due. Here's where it gets tricky. If your insurance premium or property taxes increase, your escrow account needs more money to cover those bills. So your lender raises your monthly payment to keep the account balanced. That's why you might get a letter saying your escrow is shortage in $800 or your new payment is $150 higher per month. It's not because your rate changed, it's because your taxes and insurance did. Raising costs. Let's break down why those costs raise. Property values go up, taxes go up. When your county reassesses your home's value, your property taxes adjust to match. Insurance costs increases. As home prices, construction costs, and inflation rises, does insurance premiums. Your HOA fees, maintenance, amenities, or reserve funding needs can cause those dues to climb as well. Basically, your payment evolves as your home and neighborhood does. If you've learned something new so far, hit that like button, subscribe, and comment below. It helps me reach more buyers and agents who need this information. What are some common triggers? Here are some of the biggest reasons people see unexpected payment jump. Underestimated taxes on new construction. Counties often reassess after the first year when the full home value is recorded. Previous owner exemptions ending, like homestead or senior discounts, that no longer apply once the property sells. County-wide reassessments. Many areas reevaluate property values every 2 to 3 years, increasing taxes across the board. If your payment suddenly rises after the first year, one of these is probably why. Renting isn't immune. Here's a little perspective. Renters face the same thing. When a landlord's property taxes or insurance go up, they pass those increases to their tenants. Even though your mortgage payment can rise, renting doesn't protect you from higher housing costs either. At least as a homeowner, you're building equity every month while those costs change. How can you plan for it? Here's how smart homeowners stay prepared. Don't max out your budget. Give yourself breathing room from day one. Keep an emergency fund, at least a few months of housing expenses for surprises. Review taxes and insurance annually. Shop around for better rates and understand local assessments. Stick with a fixed rate loan for predictable principal and interest. That's your stable foundation. A little preparation goes a long way towards avoiding payment shock. Now here's a bonus tip. If you know your taxes or insurance are likely to rise, you can add a little extra to your escrow each month. That way, when renewal time comes, you're already ahead and you avoid that dreaded escrow shortage letter in the mail. Even with a fixed rate, your mortgage payment isn't set in stone, but that's not always a bad thing. It means your home value and your community are growing. The key is planning ahead, budgeting smart, and reviewing your escrow regularly. If you're looking to buy in the Savannah area, Cooler, or Florida, I'm your girl. I'd love to help you with your mortgage journey. Follow me for more mortgage tips, and don't forget to like, share, and subscribe to my channel. This is Angelica with Key Mortgages. I'll see you next video.